Hey scholars, what we're now going to do is we're going to try an exercise that specifically is going to look at things like controlled foreign corporations. We're going to look at subpart F income. We're going to look at GILTI, and we're going to look at BEAT. We got a lot of great stuff to cover, so get ready. All right, let's take a look at this company. We have Blue Bean Inc., and it purchases a 15% interest in Arabica SA, which is a corporation in Coffeestan. In other words, another country. So therefore, we own 15% of them. Well, we got to do a couple of things here. So if more than 50% are U.S. shareholders, we have to examine that. It will be considered a controlled foreign corporation. So let's start out with who owns it. A U.S. person owning at least 10% is a factor here. So we're going to take a look at the various people. Let's start. A U.S. citizen or resident, domestic partnership, corporation, estate, or trust. That's what we're looking at. They're ultimately going to be considered U.S. persons. So let's see who owns them. We got Blue Bean. They own over 10%. So ultimately, they're going to have an issue with this GILTI. George? No, George doesn't have anything there. So let's put an X through him. Another company, 5%? Nope, that's nothing. Let's put an X through that one as well. All right, notice here, the next item is Bill. Bill is a U.S. resident. Even though he's a citizen of another country, he is U.S., he counts. And another 50% owned over 10%. So we have Dwight Inc. in this particular case. So we've got at least three. Oh, and then Jeffrey. Jeffrey owns 10%. So we have these four are going to count. So we have Blue Bean Inc., Bill, Dwight Inc., and Jeffrey. The two that won't count are George and the XYZ company. Now let's turn our attention and let's understand. So if we get rid of George and we get rid of that other stuff because they don't meet the standard test. So we are a controlled foreign corporation subject to subpart F income. You bet we are. So foreign-based income includes passive income, such as interest, dividends, rent, royalties, and annuities. All those things that you can just put your feet up and wait for the postman to deliver the mail. It also includes some active income, if it's tied to related parties. So here, if this corporation is selling to Coffeestan and it's selling at a discounted price, and then they're selling it at a full price to someone else, so most of the profit here is going to be taxed in a low taxed jurisdiction. They're also related parties. They're going to have to be taxed on this. That's the issue. Ultimately, we're trying to shift our manufactured goods or services to another country, a low tax country. And the way we're doing that is we're selling our product. We're selling it at basically cost so that there's no profit in the high tax jurisdiction. Now, the low tax jurisdiction, which is a related party entity to us, they get it, they sell it, and they think that they're only going to pay the low tax. Well, not so fast, we say. In this particular case, let's take a look. So it becomes a foreign-based company income. When they make these sales, they're going to draw some of that back to the shareholders. Who are those shareholders? Well, we have 15% for Blue Bean. We have 11% for Bill. We have 50% for Dwight, and we have 10% for Jeffrey. So we ask ourselves, hey, what are we guilty of? Right? And the answer is the inclusion. A U.S. shareholder's share of that foreign corporation's income, less the net tangible income return, is going to be what we are subject to. So as we've said, it's going to be those four individuals. It's going to be the 15% owned by Blue Bean, a U.S. company, the over 10%, 11 owned by Bill, a U.S. resident, the 50% owned by Dwight, a U.S. corporation, and the 10% owned by Jeffrey, a U.S. citizen. All of those are going to be factored in. George will not because he doesn't own at least 10%, and the XYZ company is a Brazilian company, so we don't have any issues there. So notice, we're going to get a deduction, but only corporations are going to be eligible for a 50% deduction of the GILTI tax. All right. So in this case, even though there are 4 subject to the GILTI income inclusion, only 2 will actually get a 50% deduction. And which 2 are those? The 15% owned by Blue Bean Inc., because they're a corporation, and the 50% owned by Dwight Inc., they're a corporation. The other 2, which was Bill at 11 and Jeffrey at 10, they don't get it because they are individuals, not corporations. So ultimately, that gives you a little bit of an idea about how the GILTI deduction works. We're now ready to try a full-blown exercise. Good luck.